Looking at the implied open for today, Thursday, July 16th, 2026, the futures market looks honestly like it's barely breathing.
Yeah, totally flat.
Right. I mean, the Dow is perfectly flat. S&P 500 futures are down like a microscopic 0.08%. And the Nasdaq is sliding just a really modest 0.36%. So for a casual observer, the tape just suggests this lazy, low-volume summer Thursday, like nothing to see here.
But the reality is that the pre-market volume is actually surging, and the underlying data tells a completely different story.
Oh, absolutely.
The tape is essentially a rope in this massive macroeconomic tug-of-war right now. Both sides are pulling with maximum force, which, it keeps the center completely stationary, but the tension underneath is historic.
Which really brings us to the mission for today's deep dive. We've got our hands on a dense, really high-stakes institutional market strategy memo that was circulated just hours before the opening bell today.
Right, the overnight session memo.
Exactly. The goal here is to take you behind the scenes of this pre-market playbook. We're going to decode where geopolitics, massive corporate mega deals, and hard economic data are violently colliding before the market even opens.
Because you really cannot trade the headlines today. If you just look at the surface news, the cross currents are, they're entirely contradictory.
Yeah, completely.
We have explosive M&A rumors lifting certain sectors, defensive blue chip stocks acting like high-growth tech, and then actual high-growth tech getting totally punished for delivering flawless earnings.
So we're going to break down why blockbuster semiconductor earnings are triggering sell-offs, why big pharma is suddenly throwing, hundreds of millions at psychedelic medicine, and probably most importantly for your own portfolio, we're going to map out the massive pain trade that retail investors are about to walk right into.
Yeah, to understand the individual gappers this morning, you really have to start with that macro tug of war. The entire global market is currently pinned between these two massive opposing forces.
Okay, let's pull the rope on the geopolitical side first. Late yesterday, U.S. forces executed a massive second wave of precision airstrikes targeting Iranian military installations right in the Strait of Hormuz.
A huge escalation.
Right. And that is a geographical choke point responsible for roughly a fifth of the world's daily oil consumption. In a vacuum, a military escalation of that magnitude in that specific transit route should trigger an immediate flight to safety.
Oh, you'd expect a massive spike.
Right. We should be seeing spiking crude oil deep red across the equity boards. Yet, like we said, Wall Street is gearing up for this cautious, neutral open. How are they holding the line?
Well, they're holding the line because of the counterweight pulling in the exact opposite direction, which is highly supportive U.S. inflation data. Institutional money is currently weighing the localized risk of a geopolitical oil shock against the global reward of a cheaper cost of capital.
And right now, cheaper money is winning the tug of war.
Exactly. It's winning out.
You're referring to the June Producer Price Index, the PPI numbers that just dropped?
Yeah, June's PPI contracted by 0.3% month over month. That is a definitive signal that inflation is cooling off at the wholesale level before it even reaches the consumer.
Wow, okay.
And the bond market instantly priced this in. The 10-year Treasury yield tanked to around 4.55%, pulling back sharply from its weekly highs. Concurrently, the U.S. dollar index, the DXY, broke down to a one-month low, sitting near 100.48.
Okay, wait, let's pause and map out the mechanics there for the listener, because, the Federal Reserve watches wholesale inflation closely. The drop in PPI basically vaporized the market's expectation for a July Fed rate hike.
Oh, totally vaporized.
Because earlier this week, futures were pricing in a 45% chance of a hike. As of this morning, those implied odds have plummeted to 11%.
Right.
But how does a weaker dollar and a drop in the 10-year yield act as a safety net against, the panic of Middle East airstrikes?
So it really comes down to the financial architecture of the companies dominating the S&P 500. Let's look at the currency side first. A weaker dollar is a massive immediate tailwind for multinational tech giants. Companies like Apple or Microsoft generate a huge percentage of their revenue overseas in foreign currencies. Euros, yen, pounds.
So when the U.S. dollar drops in value against those currencies, the foreign cash they already collected suddenly converts back into more U.S. dollars on their balance sheet.
Exactly.
They didn't sell a single extra software license or smartphone, but their bottom line earnings inflate simply because of the exchange rate.
Precisely. It's like an automatic profit multiplier. Now, you combine that with the 10-year yield dropping to 4.55%. This alters the discount rate. High multiple growth stocks are valued based on their future cash flows, right?
Right.
When you buy a tech stock, you are paying for the profits they promised to make 5 or 10 years from now. When interest rates are high, that future money is worth less today because you could have just put your money in a risk-free government bond yielding 5%.
But when that risk-free rate drops down to 4.55%, the mathematical model completely shifts. Those future tech profits suddenly look way more attractive, which immediately supports higher valuations today.
Yeah, that dual mechanism, the currency conversion boosts and the lower discount rates,
Yeah.
it's providing enough structural support to the S&P 500 to offset all the geopolitical anxiety.
However, the strategy memo points out a major fracture in that support. While U.S. inflation data is anchoring the market, an overnight shock in Asia is actively dragging on the tech sector. It's creating this bizarre, severe liquidity trap.
The Asian tape was brutal last night.
Brutal. While the U.S. was sleeping, the Asian semiconductor space took a massive hit. South Korea's Kospi index dropped 6.6%, and major memory chipmaker SK Hynix plunged 11.2%. And the catalyst wasn't even earnings. It was a surprise interest rate hike from the Bank of Korea.
Which is just a brilliant example of how interconnected global capital really is today. I mean, when the Bank of Korea unexpectedly hikes rates, they are attempting to cool down their domestic economy. But South Korea is one of the premier hubs for global semiconductor manufacturing.
Right, so a rate hike there increases the cost of capital for massive foundries that require billions in continuous investment.
Exactly. And it also signals to global markets that central banks are still willing to crush consumer demand to fight localized inflation, which directly threatens future sales of the consumer electronics that, actually require those chips.
So we've got U.S. data pulling yields down, fighting Asian central bank data pushing borrowing costs up, all while geopolitical tensions simmer in the Middle East. It perfectly explains why the futures tape is flat. But the memo uses a specific term for the resulting market environment, a liquidity trap. How is the smart money defining this trap today?
So when there's no clear directional dominance, like no obvious trend up or down, the algorithmic options dealers basically take over the tape completely. They establish mathematical boundaries, essentially turning the market into a magnetic ping-pong table. It's driven by a state called positive gamma.
Let's demystify positive gamma. How do options dealers mechanically trap the indices?
Think of major options dealers like casino bookies taking bets from the entire market. They don't want to gamble. Their goal is to remain perfectly neutral and just collect the transaction fees.
Right, collect the spread.
Exactly. If the market starts to drop, the dealer's risk exposure shifts, and their algorithms are mathematically forced to buy the underlying stocks to rebalance their books. In the S&P 500 today, they've built a massive, heavily guarded support zone between 7,532 and 7,553. If the market dips into that zone, institutional buying automatically kicks in. It acts as a giant shock absorber.
But the inverse happens at the ceiling. The memo outlines a massive resistance wall between 7,580 and 7,600. If the market rallies into that zone, those same options dealers are forced to aggressively sell stocks to stay neutral, knocking the index right back down.
That's the trap. The line in the sand is drawn. Breakout traders who see the market pushing above 7,580 will buy in, assuming a new rally is starting, only to get instantly crushed as the dealers sell it back down.
Wow.
And conversely, panic sellers who short the market below 7,530 thinking the bottom is falling out, well, they'll get squeezed as the dealers auto-buy the dip. And by the way, the Nasdaq is pinned in an identical chop box between 29,696 and 29,770.
Meaning that unless we get a definitive high-volume daily close outside of those specific boundaries,
Right.
trying to trade the broader index momentum today it's basically financial suicide. You're just fighting the dealer algorithms.
100%.
Which perfectly explains why institutional capital is abandoning the broader indices this morning and rotating really heavily into specific individual corporate catalysts. The pre-market volume is heavily concentrated in massive mergers and acquisitions.
Yeah, when the macro environment is paralyzed like this, money managers seek out isolated, company-specific events where the return is detached from what the S&P 500 is doing. And this morning, the healthcare and biotech tape is just exploding.
Oh, the numbers in the neuropsych sector today are staggering. The catalyst is this explosive pre-market rumor that big pharma giant Eli Lilly is in advanced talks to acquire ATAI Life Sciences, ticker ATAI.
Right.
They are specifically targeting ATAI's Phase 2 clinical pipeline for a treatment-resistant depression drug. ATAI is skyrocketing over 44% in the pre-market to $7.73.
To put that into perspective, Big Pharma has spent the last 5 years aggressively deploying capital almost exclusively into cardiometabolic and weight loss drugs. I mean, GLP-1 inhibitors have been their primary cash cow.
Right. So Eli Lilly suddenly pivoting to buy a psychedelic medicine company it's like a massive Hollywood studio that has spent a decade exclusively printing money with superhero movies, suddenly pivoting to fund an indie psychological thriller.
That's actually a great analogy.
It completely shifts the narrative. It validates what was previously considered a highly speculative fringe clinical space. It signals that it could be the next high-stakes cash cow.
And we can see the ripple effects in the pre-market order flow right now. When a behemoth like Eli Lilly validates a sector, it triggers a domino effect across all peripheral assets. So we are tracking a massive short squeeze across the broader neuropsych space today. GH Research is up 12%.
Wow.
Compass Pathways is jumping 8%.
So traders who bet against those psychedelic companies are scrambling to buy back the stock and cover their short positions because they realize that if Eli Lilly is shopping, Pfizer and Johnson & Johnson might start looking for acquisition targets too, just to diversify their own pipelines.
Exactly. It's a scramble.
But as fascinating as that biotech validation is, the highest volume gapper this morning is actually in the payments sector. PayPal, ticker PYPL, is spiking 17% in the pre-market to around $55.41.
This is a bombshell.
A total bombshell.
Privately held Stripe, backed by the private equity firm Advent International, has reportedly launched a $53 billion take-private bid for PayPal. That would be a historic buyout, completely reshaping the digital payments infrastructure.
Okay, here's the mechanic that we really need to unpack for the listener today. The reported cash offer from Stripe is $60.50 per share, but PayPal stock is currently hovering at $55.41. That is roughly an 8% discount to the actual offer price on the table. If a buyer has publicly offered $60.50, why doesn't the market instantly price the stock at $60.50?
Well, that 8% gap is what institutional traders call an arbitrage spread.
Yeah.
It's a real-time mathematical representation of the market skepticism. Investors are not just pricing in the offer, they're pricing the probability of the deal actually closing.
So buying PayPal at $55 right now isn't really a bet on PayPal's underlying payment volume. It's basically a bet on corporate lawyers and regulators.
Yes, exactly.
Because the bear case here is obvious. Combining Stripe and PayPal creates an absolute monopoly in online checkout infrastructure. Antitrust regulators in the US and Europe could easily file injunctions to block the deal. Furthermore, PayPal's board could just flatly reject the bid. If the deal falls apart, that $55 stock price is going to instantly gap down to its pre-rumor floor of around $47.
Right. The arbitrage spread prices in that downside risk. But the bull case for why institutional buyers are aggressively accumulating shares at $55 lies in PayPal's current valuation metrics. PayPal has been trading at a historically depressed 9x trailing multiple.
Meaning the market was pricing the entire company at just 9 times its actual trailing 12-month earnings. For a tech company, where average multiples often sit between 20 and 30 times earnings, a 9x multiple suggests the market previously viewed PayPal as a stagnant legacy business rather than a growth engine.
Right. And because the valuation was so severely compressed, activist investors have a massive opening. The bull case is that Stripe's initial $60.50 offer is nothing more than an opening salvo. Now that PayPal is officially in play, activist shareholders can aggressively pressure the board to demand a higher premium. Morningstar's long-term fair value estimate for PayPal is actually closer to $80 a share.
Wow.
So traders buying at $55 are betting that a bidding war or activist pressure will force Stripe to bump their offer closer to $70 to secure board approval.
That really highlights a fascinating psychological shift in the market. M&A rumors like PayPal and ATAI represent where investors hope the market is going. They trade on theoretical future premiums. But when we look at the actual earnings reports that dropped this morning, we see a much harsher reality of what investors demand from operational companies right now.
Yeah, M&A is hope, earnings are reality.
Exactly. Look at Taiwan Semiconductor, ticker TSMC. They just released their Q2 report, and the underlying data is phenomenal.
By almost every historical metric, it was a flawless quarter. I mean, net profit surged 77.4% year over year. Top-line revenue jumped 36% to over $40 billion US. They confirmed that global AI demand remains ravenous. They even announced an incremental $100 billion capital expenditure plan to build out localized manufacturing capacity in Arizona.
They are the undisputed backbone of the global AI hardware revolution, firing on every cylinder. And yet the stock is down 3.5% in the pre-market to roughly $419.48. They deliver a 77% profit surge and commit $100 billion to U.S. infrastructure, and Wall Street punishes them.
It's the ultimate sell the news event, and it all traces back to the second derivative, the rate of change. The market is entirely forward-looking. They don't care what TSMC earned yesterday. They care about the profit margins tomorrow.
Right.
And inside that blockbuster report, TSMC projected a slight contraction in their Q3 gross margin guidance. They expect margins to drop from 67.7% down to somewhere between 65% and 67%.
Look, in a rational market, a 65% gross margin on physical hardware is incredibly lucrative. But we need to explain why that margin is contracting because it goes to the core physics of their business.
The 2-nanometer transition.
Yes, they are ramping up mass production of their next-generation 2-nanometer chips. Manufacturing silicon structures at an atomic scale requires utilizing extreme ultraviolet lithography machines that cost hundreds of millions of dollars each. The upfront capital expenditure required to transition to 2-nanometer architecture is astronomical, and that heavy spending naturally dilutes their near-term profitability.
Precisely. And the market is incredibly unforgiving to capital-intensive transitions right now. When you couple that slight margin contraction with the overnight hangover in the Asian tech sector, driven by the Bank of Korea rate hike we talked about, institutional investors just decided to immediately de-risk. They locked in their profits on TSMC rather than wait for the 2-nanometer ramp-up.
Which provides a stunning contrast to how capital is treating the defensive sectors this morning. While investors dump the most important semiconductor company in the world over a 2% margin dip, they are flocking to managed care.
Oh, absolutely.
Look at United Health Group, ticker UNH. They operate in health insurance and pharmacy benefits. They posted a quiet, solid beat. $112 billion in Q2 revenue, adjusted EPS of 6.38 cents, and they actually raised their full-year guidance to up to $20 a share.
It is a fundamentally boring business model. No AI hype, no 2-nanometer fabrication, just consistent premium collection.
But the stock is catching a powerful bid this morning. When institutional capital flees a 77% profit surge in next-gen tech to hide in the predictable cash flows of a health insurance provider, it clearly signals that the smart money is prioritizing capital preservation over growth.
Which perfectly transitions into the most critical warning in the strategy memo. We've mapped the geopolitical threats, the algorithmic liquidity traps, and the ruthless earnings environment. Now, we really need to talk about the pain trade.
The pain trade.
Yeah. Institutional money thrives by identifying outdated assumptions held by the broader retail market and positioning against them to inflict maximum losses.
Okay, let's lay out the exact parameters of this trap for you, the listener, so you don't become the liquidity for Wall Street today. Let's assume that this morning's cooling PPI data is a head fake. Let's say the conflict in the Strait of Hormuz drastically escalates, crude oil shoots past $100 a barrel, inflation reignites, and the 10-year Treasury yield violently spikes back up toward 5%. If that happens, what is the outdated playbook that everyday retail investors are going to use?
So the standard retail reflex built over the last 2 decades is simple. When interest rates go up, technology stocks go down. So if yields spike, retail traders will immediately short the mega-cap tech stocks companies like Apple, Alphabet, and Microsoft. Simultaneously, to protect their own portfolios, they'll try to lock in those higher yields by aggressively buying long-duration government bonds using ETFs like TLT, assuming that eventually the Fed will have to cut rates and bond prices will rally.
So they short the biggest companies in the world and buy 20-year government bonds. Mechanically, why is executing that exact strategy in 2026 a fatal mistake?
Because it completely ignores the massive shift in the financial architecture of mega-cap tech. A decade ago, tech companies relied on cheap borrowed money to fund their growth. If borrowing costs went up, their margins collapsed. But today, the Magnificent Seven are sitting on hundreds of billions of dollars in pure cash reserves. They are no longer net debtors, they are net creditors.
They took all that cash and swept it into high-yield, short-duration instruments. So if the 10-year yield spikes to 5%,
those tech giants actually generate billions of dollars in additional interest income. They are essentially operating as their own high-yield savings accounts. So when the macro environment panics over rising rates and retail traders aggressively short these mega caps, the tech companies just sit back, collect massive interest payouts, and their stock prices stay highly elevated. The retail short sellers are then caught offside and squeezed into oblivion.
If the mega caps are immune to rate hikes, who is actually vulnerable? Who gets crushed?
The real victims are the unprofitable, highly leveraged, speculative tech companies, the businesses that actually do need to issue new debt at those higher interest rates just to keep the lights on. The danger is that retail buyers, trained to buy the dip on any tech stock, step in to catch a falling knife on speculative software companies, falsely assuming that tech always recovers. Those highly leveraged companies might never bounce back.
Wow. And what about the second half of that retail playbook, the traders buying the long-term government bonds, hoping to lock in the yield?
Well, they step into a brutal mechanism called duration risk. Long-term bonds are currently suffering through a historic 71-month drawdown. It's the longest consecutive bear market for bonds in modern financial history.
71 months.
Yeah. The mechanism is simple. If you buy a 20-year bond today yielding 4%, and next month inflation forces yields up to 5%, nobody wants your 4% bond anymore. To sell it, you have to aggressively slash the price of your bond to make up the difference. Retail investors constantly try to pick the bottom of the bond market, assuming the pain is over. But if we enter a structural, higher-for-longer inflationary environment, holding those long-duration bonds will just continue to slowly vaporize their principal capital.
So the institutional pain trade is essentially a three-pronged trap. Shorting cash-rich megacaps that actually profit from high rates, buying the dip on highly leveraged junk tech that gets crushed by borrowing costs, and bleeding out principal by holding long-term bonds in a rising rate environment.
Exactly.
It completely inverts the traditional logic you read in entry-level finance books.
Which is exactly why you have to look beneath the surface. Knowing a company's balance sheet, whether they are a net creditor or a net debtor, is really your only defense against a macroeconomic trap like this.
Let's synthesize the morning and pull everything together. The pre-market tape for Thursday, July 16th, 2026, is defined by immense contradictory pressures. Cooling U.S. wholesale inflation is actively fighting against the geopolitical risk of airstrikes in the Middle East. That specific tug of war is trapping the broader S&P 500 and Nasdaq in a tight algorithmic liquidity box.
Right, the ping-pong table.
Exactly. And because the broader market is paralyzed, institutional capital is hunting for alpha in massive corporate catalysts, driving explosive take-private rumors in the payment space with PayPal, and fueling a major short squeeze as big pharma pivots into psychedelic medicine. Meanwhile, flawless execution by Taiwan Semiconductor is being punished due to the heavy capital costs of next-generation innovation.
It is a tape that demands absolute precision from active traders today. And keep in mind, the tension is not going to dissipate at the closing bell. All eyes will shift to Netflix, who reports their earnings this afternoon. The market desperately needs to see if a massive consumer-facing streaming giant can break the tech sector's current margin curse, or if we are staring down the barrel of a deeper, fundamental summer correction.
It is going to be a highly volatile afternoon session once we finally break out of that options chop box. But before we sign off, I want to leave you with a final thought to ponder, one that builds directly on what we just unpacked regarding the retail pain trade. If the world's largest technology companies are now sitting on such massive cash reserves that they structurally profit from rising interest rates by collecting billions in yield, are our traditional market classifications completely obsolete?
That's the million-dollar question.
Are we still trading technology and software companies, or have the mega caps essentially evolved into massive, unregulated banks that just happen to sell search algorithms and smartphones on the side?
It's a profound paradigm shift. It completely redefines how institutional risk models are built, and honestly, it should change how you look at the Nasdaq.
Definitely something to analyze the next time you review your portfolio allocations. The futures might look quiet right now, but the mechanics underneath are violently resetting. Thank you for joining us on this deep dive to decode the tape. We'll catch you next time.